But Shanghai closed in the red. After hitting a one-month high, the rupee today snapped a four-day winning streak as worries over the country's widening trade deficit weighed on the currency. There are fears that the face-off between China and the U.S. over Taiwan could spell more trouble for the Indian industry, which has been battling a semiconductor shortage for the past 2 years.
Just as the Indian auto industry was emerging from its worst slowdown ever, there are fears the semiconductor supply crisis could return. These images of the latest and most potent weapons in the arsenals of China and the US have rattled the world these past 2 days, with the industry dreading the prospect of China throttling the supplies of semiconductors from Taiwan. Last year, Taiwan controlled 63% of the world's semiconductor supplies. South Korea, with companies like Samsung, had 18% of the market, while China had a 7% market share. US and other countries had the remaining 15%. Simply put, the world is dangerously dependent on Taiwan for its chip supplies. The great chip shortage of 2021 startled the industry and the world, which rudely woke up to the fact that their most critical high-tech components were at the mercy of foreign nations. This was what tech major IBM said in a white paper in March 2021. You never want to be in a spot where another nation can control a valuable resource that your nation depends on. The US, wary of the global tilt, passed a mega $280 billion CHIPS Act, which received rare bipartisan support in both houses of the Congress. India, which announced its $10 billion semiconductor policy last December, has only taken some baby steps in the area. The country still imports 100% of its chip supplies.
भारत चिप टेकर से चिप मेकर बनना चाहता है। सेमीकंडक्टर्स का उत्पादन बढ़ाने के लिए भारत में तेजी से निवेश बढ़ रहा है। यानी मेक इन इंडिया की शक्ति और डिजिटल इंडिया की ताकत की डबल डोज भारत में इंडस्ट्री 4.0 को नई ऊंचाई पर ले जाने वाली है।
However, most of India's chip imports are from China and not Taiwan. Ministry of Commerce data shows India imported over $8 billion of digitally integrated circuits alone in 2021-22, of which China accounted for over 50% of supplies, a rise of 106% on year. This was followed by Hong Kong at around $1.85 billion. Singapore took third place, supplying chips worth $547 million, while Taiwan came fourth with supplies worth $470 million. Meanwhile, at least two international consortiums have expressed interest in investing in the semiconductor industry in India, with Karnataka, Gujarat, Maharashtra aggressively wooing the technology. While India may not be in the fab picture at present, one of the big advantages it enjoys is its strength in chip design. Nearly 20% of the world's design engineers are Indians, and most are employed by foreign companies in India. Bureau Report, Business Today Television.
To get an expert view on what the impact, even the smallest one, could be on India and Indian consumers, we have with us Neil Shah of Counterpoint Research.
If something happens with respect to geopolitical tension between China and Taiwan, and TSMC has become more strategic in a sense for China with its semiconductor ambitions, and to protect those, it could seriously affect the overall supply in the industry, because if China makes a move, obviously TSMC relies a lot on equipment and technologies from countries outside of Taiwan, which is US, Japan, Europe, and so forth. So if something happens, it's going to be a big blow for the entire industry, not just India, but entire industry. And to be specific, 80% of the smartphone chipsets right now are actually being manufactured at TSMC. So, which is huge. And when you add PCs and tablets and so forth, which is growing in terms of semiconductor content, even the data storage and cloud, as we have seen with the recent Intel and AMD earnings, everything is shifting towards more on TSMC being one of the big fab for manufacturing those. So India is reliant on semiconductors from chipset perspective. Almost 27 to $30 billion of semiconductors will be imported this year in India, and bulk of it, which are the high value items, are churning out from TSMC.
The country's largest homegrown car manufacturer, Maruti Suzuki India, has recorded sales of over 1.75 lakh units in July 2022, an increase of 8.28% year-on-year. My colleague Chetan Bhutani caught up with Shashank Srivastava, Senior ED at Maruti Suzuki. Here's what he had to say about the auto sector revving up.
Tell us about the numbers. 1.75 lakh units sold in July. What is your outlook for the numbers going ahead, and what really led to that 7 to 8% growth?
Overall, the industry seems to have done really well. 342,000 is the highest ever monthly numbers for the industry ever. And that is compares very favorably with last year's 295,000. So it's like a 16% growth over last year. So good, the numbers, even and definitely that reflects easing of the problem of production vis-a-vis the semiconductor issue, and we are currently at around 95% of the issue solved in that sense. So wholesale numbers look good, although I must say in the last 4 months the retail have been lower than wholesale. So there is some buildup of the stock within the network, but still very small compared with the normal long-term average of stock that we see in the industry.
Shashank, how is the shortage of semiconductors, and is the pressure on profits still there, or inflationary issues are still there for the company?
So on the semiconductor, it's getting better. Last at about 40% at the bottom in September last year, 40% of our plant production. But now we are around that 95% mark. Clearly, we're still not at 100%, and I don't expect it at 100% in August or in September. So this problem will continue in this quarter as well. But at a much higher level, we are now at 95%. And that is reflected in the production numbers as well. But going forward, I can't really give you a very clear timeline on when 100% issue will be solved, because we do not have the visibility for semiconductor component availability beyond a few weeks in the future. So as we go along, we keep revising the estimates. On the profitability front, which you had mentioned, yes, commodity prices have been very high. In fact, when you compare it with 2 years back, they are still very high, even though you have seen some softening in the recent weeks. Like steel, which was 37 rupee a kg 2 years back, went up to 84, now around 60, 62, but still, very high compared with 37 per kg that you saw. Same with copper, going up from $5,500 to $10,400, now softened a little bit to about $9,300, but still quite high when you compare with $5,500 2 years back. Same story is there with aluminium as well. So while there is a softening in terms of the commodity prices, but still compared with 2 years back, still quite high. And that is another area where we are making a close watch on the trends in the commodity prices.
With media rights for the marquee Indian Premier League bringing in a whopping 48,390 crore rupees, there's a lot of interest in how much the International Cricket Council or the ICC rights will fetch. They're currently held by Disney Star India after being acquired in late 2014 for $2 billion.
Despite the mega success of IPL media rights auctions, not all is hunky-dory with ICC prospects. IPL brought in a massive 48,319 crore rupees, raising hopes that the International Cricket Council will also reap the benefit of the advertisers' generosity. ICC is auctioning media rights for a total of 711 matches. This includes 16 men's events with a total of 362 matches and 6 women's events. Over 4 years of a total of 103 matches. Other matches comprise under 19 men's and women's games. The last auction in 2014 netted ICC around $2 billion or 12,000 crore rupees. This was for the period of 2015 to 2023 and was twice the amount paid in the earlier bid. Taking a leap out of the IPL bid, the track of this time has been to split the rights in and all. There are 6 packages across television and digital, separate for men's and women's events. 3 are of an offer with Package A for TV rights, Package B for digital rights and Package C for combined TV and digital rights. The big attractions in the ICC rights are the World Cup, T20 World Cup and the Champions Trophy. Apart from Disney Star, it is expected that Viacom 18, Sony and Zee will evince interest, but the extent to which they push themselves remains to be seen. For one, the winners of the key IPL rights, Disney Star and Viacom 18, have spent huge amounts. It is also not clear how much the ICC rights incrementally brings to the table for broadcasters. The third X factor is the performance of India in tournaments. An early exit by India, like in the 2021 T20 World Cup, hits audience numbers big time and has a crippling effect on advertising revenue. The bids close next month. Analysts feel that while Disney Star will try to retain the rights, both Sony and Viacom 18 will bid aggressively to win. For Star, it is about maintaining the monopoly, while for Sony and Viacom 18, it is about growing and establishing their sports verticals. Bureau Report, Business Today Television.
Let's take a very quick break. When we come back, ask to them. Hello and welcome. You're with us here on Business Today. You're watching Ask Uday, and the show where we answer your queries on stocks. The stock markets have been turbulent, of course, but seems to be coming back on track. A whole confluence of factors that we continue to track for you. At such a time, how can you smartly invest in the stock markets and have a balanced portfolio to earn decent returns? To know the right strategy, keep sending in your questions to us at the number on your screen, and we'll answer a select few on TV and online every Wednesday. Our global business editor, Uday Mukherjee, joining us now to take those queries with you. Let's start off with our first query today. And this one is coming in from Saurabh Sharma in Pune. Listen in.
Hello, Udyan. I am Saurabh Sharma from Pune. I have 100 shares of Piramal at rupees 2,500. Please advise what I should do next.
Well, you've bought at a higher price and the stock has corrected quite a bit. And part of the reason, of course, is some of the disclosures which came in after the Q4 on their balance sheet did not go down very well with the market. But, the peak was nearly 3,000 for Piramal, if I remember correctly. You bought at 2,500 and the stock is now languishing around 1,800. I see Piramal as a WIP stock, work in progress. It's very difficult to make a firm assessment of how to value this company today because it has two core businesses. One, of course, is the old pharmaceutical business, and the other is the relatively new business of them having acquired DHFL, the erstwhile Diwan Housing, and now trying to leverage on that housing finance business, the mortgage business, to make it a far bigger retail vehicle for the finance side of it. So we'll need a couple of years. We'll have to give them a couple of years to see where they can take their finance business and whether they can make that transition from a housing finance company to a more holistic retail financing company, because that will drive the valuation for Piramal going forward. The pharmaceutical business, the CDMO business, is a stable growth business. I think you can continue to get about 15% kind of growth in that business. But it's on the margin, it's the finance business of DHFL, and what Piramal manages to do with it is what is going to drive the share price. But in the near term, I think you'll have to be patient. You're sitting on a fairly significant loss of 25%. I don't know whether it makes sense to sell it off, but don't expect this stock to be a rocket in the near future. I think it will have to prove its mettle on the retail front, and that will take at least the next 2 to 3 years. Before that, I don't see you making very substantial gains.
All right, Ashok Kumar from Noida also has a query. Let's listen in to which stock he's tracking.
Sir, I am having 273 shares of HCL, which I purchased at the rate of rupees 1100. Now please advise me how to proceed. Shall I quit or continue? As on date, the share value is below the purchase price. Thank you.
It's a difficult one on HCL Tech. I don't know. I am not here to give you a buy or sell recommendation at all. But I think it probably makes sense to switch from HCL Tech to the sector leaders. If you want to be in the top 4, which HCL Tech is, then probably Infosys or TCS make for better bets, because their valuations too have corrected, maybe not as much as HCL Tech, but in a relative sense, I think there is more stability and predictability in those frontline names. Even in the quarter gone by, the reason why the stock has come down below 1,000 rupees is the EBIT margins for HCL Tech were not great, and they've given guidance of 18 to 20% EBIT margin, but the margin came in at 17%. And looking at that margin profile, I suspect that while they may get 12-14% kind of sales growth in FY 23-24, I don't think they'll be able to report earnings growth for more than 10 or 12%. So for a 10-12% earnings growth, do you want to pay a 16-17 PE multiple? Or are you better off seeking the stability of Infosys or TCS? My suggestion would be, if you get rallies in HCL Tech which takes it close to your purchase price, it may not be a bad idea to consider switching to the big two, either TCS or Infosys.
All right, Pinakin Patel now from Surat, and let's take a look at his query. I think it's on IGL this time.
Hello, sir. I have a 150 numbers of Indraprasth Gas IGL. Should I have hold, add more, or sell it? Because since last 3 years, there is no movement in IGL. And what is the future of gas sector?
Well, there's a reason why the stock is consolidating over the last 4 or 5 months between that 350-400 zone. Because there are some defensive characteristics to IGL. For example, it's not an expensive company. For a 20% plus ROE company with no debt on its balance sheet, you're getting it at 14p or thereabouts. So valuations are in IGL's favor, which is why the stock has not collapsed below 300, 350, though it's come off a lot from that high of 600 which it hit last year. But the reasons which are worrying most market participants about IGL is that what is the future of the CNG business in the light of the kind of prospects people are seeing for electric vehicles? For example, the Delhi government is already saying that they will put EV buses on priority compared to CNG buses. This is clouding the future for growth for a company like IGL. I mean, even if you look at its core non-transportation CNG business, the Delhi government again is saying that we will net for a portion of it, we will now have open access and let other players come in. So that challenges the dominance of IGL in the core CNG business as well. And on the other hand, LNG prices have been going up and that squeezes margins. So I think the directional challenge is what happens to CNG post-electric vehicles and whether this is the right time to be buying a company like IGL, or is it a sunset kind of a sector, which is the fear which a lot of investors have. So keeping all this in mind, I think you may be better off considering some kind of a switch to a sector which less clouded prospects, should I put it like that, because I think this issue will continue to dog IGL in the years to come.
Saurabh Makkar has also written in from Gurugram. He's looking at Zydus Lifesciences.
Hi Aryan, this is Saurabh from Gurgaon. Just wanted your inputs on Zydus Lifesciences and pharma sector in prospects in the short run. I'm holding at levels of 425. Should I book loss or average out or wait for recovery?
I don't think you will get a very large recovery immediately on Zydus. The thing with Zydus is that, which is the erstwhile Cadila Healthcare, as you know, but is that a lot of people were waiting to see if that Zycov-D trigger will play out, which is their COVID vaccine. And it looks now like that there is just no demand for COVID vaccines and that trigger is not going to play out. And if you look at the recent results for Cadila Healthcare, of Zydus, same thing, Zydus Lifesciences, their results have not been great. Margins have been under pressure from the US business particularly, and that's not going away anytime soon. The good thing about Zydus is that their balance sheet is good. They've managed to sell their animal healthcare business, so the cash has come in, the balance sheet is debt free, and they're even doing a buyback. So on that front, I think you have less to worry about. The problem is the core business and what are the triggers. So once one looks at triggers, there are a few floating around, but I think you'll probably find better value in the pharmaceutical business elsewhere. So no, it would not be my top of the line, top 3 or 5 picks in the pharmaceutical space. Given that the sector has been underperforming, I think there are probably better value to get elsewhere compared to the name that you own.
All right, and with that, we run out of time on this edition of Ask Udayan. Do continue to send in your queries. Udayan, thank you so much for taking all of those questions this week. We'll be back with more every week here on the show.
Make your media plan smarter with India Today Live TV on your connected devices. Everyone's busy finding what's trending. You're busy finding out why. India Today, for those who research before reacting. Download the India Today app now.
I don't read